Dr. Brian Jacobsen is our chief economist. We're going to talk about our corporate level here in a second, but let's talk about Friday's job number that arrived. What did you see? What did you think?
Yeah, so we did an instant insight on there, which is one of the webinars that we do. Hopefully you're able to join that. If you haven't, please do sign up for those. They're a lot of fun. We dig into the details of these. But really what I saw with the employment situation report was that the labor market has gone basically from too hot to handle for the Fed to something that's a little bit cooler. Now, the question is does it tip over into being like cold? Because it's almost like the three bears, that story Goldilocks and the three bears, about how it's too hot, it could be too cold, or just right. The Fed is hoping that they can get it to just right. One of the problems is with an ever-changing world, it's hard to get it just right. It's going to swing one way or the other. And I think the employment report with the headline number, 142,000 payrolls, it was softer than expected. The fear is that it's going to swing a little bit towards that too cold part.
What would be just right?
Just right would be if we had, let's say, that 142,000. I think that is pretty close to just right, because what we oftentimes look at is how fast is the labor market growing. Often it's driven by population growth, the age structure as far as people graduating, and immigration. And right now, current trends are somewhere between 100,000 and 150,000 every month that you would like to see for that unemployment rate not to be increasing or decreasing. So we're within that range. But when I look at other data points, the hiring rate by businesses, the layoff rate by businesses, the quits rates by individuals, it suggests to me that we're likely going to see that headline payroll number drift lower as the year goes on, meaning that unemployment rate continue to drift higher.
You mentioned in the notes at corporate level things weren't horrible. In fact, earnings have generally been better than expected. Yeah. Let's talk about the consumer. Are we seeing signs of them slowing down? And also, I see that Dollar General, Dollar Tree, which is, I would think, where you'd go if you wanted to save money, are actually under pressure.
Yeah, that's one of the things a lot of individuals that I've spoken to before when we've talked about, prepare for a little bit of economic slowing, not stopping. They're like, oh, well, some of these discount retailers should be in a good place. Well, competition from places like Walmart, Target, they suddenly have to contend with them, especially if you go to one of these Dollar Tree, Dollar General. Nothing against them, but in terms of what's the value that you see, it's not just about the price. And so what we've been hearing from a lot of businesses is that consumers are willing to pay for value, maybe not as much, and they're really doing more comparison shopping. And so in terms of from the corporate level, some of these companies, they're facing what they call a challenging macroeconomic environment, which is just a code for, hey, things are kind of slowing. People are getting a little bit pickier about how much they pay.
They must have put that statement into AI and it came out that way. Let's talk a little bit about AI. Now, talk about Broadcom a little bit and their results, but I'm seeing a little bit more muttering about AI.
Yeah, well, it's one of those things where starting with NVIDIA, when they were projecting, some massive growth in revenue, but it was slightly less than what some people were hoping for, is they're realizing that trees don't grow all the way to the sky, that it does eventually invite competition, growth rates do slow. And with a company like Broadcom, they have a diversified business, so they don't just do like artificial intelligence chips. That part of their business, when they reported earnings, was doing pretty well. They had a net loss for the quarter, mainly because of a slowdown in the other parts of the business, more of the mainframes, mobile, things like that. So it's the whole business, as far as the different lines, that was creating a little bit of headwind here.
Let's talk quickly about the next inflation print, the CPI, which comes on Wednesday. How key is that?
I think that's going to be very key. The Federal Reserve is in what's called their blackout period, meaning that they aren't going to make any speeches or announcements before they meet on September 18th. And so the next big data point that we get is on Wednesday with that consumer price index, where we know jobs, those are slowing. That could support 25 basis point cut, maybe 50. This CPI report is probably going to tip the scales one way or the other. If it comes in as I expect, it could actually tip it towards maybe let's do 50 instead of 25.
Another plug for the Instant Insight series. Very good stuff. That is going to be on Wednesday, 4 o'clock Eastern, 3 o'clock Central. The Fed and the markets talking about that rate cut.